Good morning, students. Namaskar, Suprabhat, Sasri Akal, Vadakkam, Cho, etc. etc. So again, I am C. Ankit Sharma, your income tax faculty, and we will be discussing, or we can say that we are going to complete our capital gain session today. I hope that you all are good and of course studying very hard to become a chartered accountant as soon as possible. So in today's session, we will be discussing the capital gain exemptions under section 54, the remaining part. After that, tax calculation on different kind of capital gain. Generally, we have long-term capital gain and short-term capital gain. But short-term capital gain is divided into two parts. That is, one is under section 111A and the other short-term capital gain. Same as long-term capital gain having two parts. One is section 112A and the other kind of long-term capital gain. So these gains have separate rates of tax. So that's why we have a specified rate for section 111A, that is 15%, and 10% for 112A. So that will be discussing in today's lecture. We will have our MCQ, of course, and MCQ will be at the end of the lecture. So we can actually consolidate all kind of question in that MCQ, including the today tax calculation provision. We will also going to discuss test your knowledge question from the study material, of course. There will be, of course, a story session. And before everything, let's say who joined the class. So good morning, Darshan. Good morning, Diksha. Good morning, Sudhanshu. Good morning, Bhumika. Good morning, Rajiv Kumar. Sushil Kumar also, good morning. Okay, someone asked me a question regarding section 45(5)(a) in the last session. And I said that I will take the screenshot and later I will discuss that question today. But what happened, the query sessions actually removed from the portal after 1 day. So when I saw yesterday, it was not there. So to whomsoever it may concern who sent that query, kindly send me today again. I will take the screenshot or a picture right now whenever you will send it. And then I will discuss it in our next session. Okay. Somebody also asked the demerger definition, and I guess we will have time today. So I will also explain the basic demerger concept with you also. Before starting anything, let's have the thought for the day. Very simple picture, very small picture in front of you. And let me show you what exactly it says. It says, the bad news is that time flies, of course, because you cannot stop the time. This is something you cannot buy. Even you have all the money of this world, you cannot buy 1 minute extra. Whatever has been passed is passed. You cannot take back the time. Until we have the time machine, we cannot do this. So the bad news is that time flies. You cannot stop that. But the good news is that you are the pilot. Very beautiful, very wonderful, very thoughtful thought technical. So the time is not in our control. We cannot take it back. We cannot go back into time and change things. But you are the pilot. It depends how you want to utilize it. So please utilize your time very carefully. Okay. And for now, of course, the most important thing in your life is to study and make your career and becoming a chartered accountant as soon as possible. So more good mornings are here from Rishita. Good morning. Akshay Kumar. Good morning. Madhav. Good morning. Komal. Good morning. Aditi. Good morning. So Darshan is also asking something. That in section 54, even when the new residential house is transferred after 2 years, but before 3 years, it would be short-term capital gain and long-term capital gain. No, if new residential house has been transferred after 2 years, it will be a long-term capital asset in section 54, because in case of land and building, the property become the long-term asset after expiry of 2 years. That will be a long-term capital gain. But whatever was the cost of acquisition of that property at the time of exemption, that will be reduced by the amount of exemption which has been claimed earlier for that property. So it will not be a short-term cap gain, it will be a long-term capital gain, because the nature of gain or asset will be decided as per the provision which has been discussed regarding the long-term capital asset and short-term capital asset. Okay. So moving on to our provision, first of all, we will complete our exemption provision. Then we will complete our tax calculation provision. Then I will discuss demerger and then test your knowledge, MCQ test, etc., etc. Okay. So those were the provision what we were discussing. We discussed section 54. The exemption under section 54 are technically investment scheme. I have told you this, that these are kind of investment scheme, and on fulfilling certain condition and investing in a certain property, you can get the exemption to set off your capital gain and reduce your tax liability. So section 54 was about if you are transferring a residential house, and against it, if you are buying or constructing a residential house, you can get that exemption. The asset transfer should be long term. The amount of exemption that you may avail is maximum for 2 residential house if your capital gain does not exceed 2 crore rupees. And that 2 houses exemption is for lifetime exemption. Only once you can claim it. After that, you can only claim 1 residential house exemption, and if capital gain is increasing or exceed 2 crore, then only 1 residential house exemption can be claimed. We discussed this provision even with the help of an example. The condition was the purchase should be completed within 1 year before transfer, within 2 years after transfer, and construction should be completed within 3 years of transfer. The new asset cannot be transferred for next 3 years. And if you do so, then in that case, the capital gain exempted earlier is going to be reduced from the cost of that asset. You have to either purchase the new residential house up to the due date of ROI, or if you are not able to purchase or constructed a new residential house, then you have to deposit the amount in the capital gain deposit scheme. The capital gain deposit scheme up to due date of ROI. The amount deposited in that scheme will be deemed as investment in the property. An exemption can be claimed in the same previous year if you deposited up to due date of ROI. So in the previous year, 20 to 23, we can avail the exemption if we deposit that amount up to 31st July or 31st October, as the case may be, in that capital gain deposits. The amount misutilized will be taxable as capital gain in the year of misutilization. The amount unutilized will be taxable in the year in which 3 years will be expired. That was section 54. Then we discussed section 54B. It was if you transfer your agricultural land and purchase another agricultural land, then you can claim exemption under section 54B. But the transfer agricultural land must be in urban area. Only in that case, this provision will be applicable. Assessee can be anyone, individual HUF, time period can be long-term, short-term, amount of exemption, the amount invested in agricultural land. Okay. Condition need to be fulfilled. Agricultural land situated in urban area was used by assessee or his parent or HUF for a period of 2 years prior to the date of transfer for agricultural purpose. The purchase duration is only 2 years. Within 2 years, you have to purchase another new agricultural land. Other conditions are exactly same, which says either purchased up to due date of ROI or invest in capital gain scheme. Misutilized will be taxable in the misutilization year, and the unutilized amount is going to be taxable in the year 2 years will be expired. Then section 54D, which talks about compulsory acquisition of land and building forming part of industrial undertaking. When we talk about compulsory acquisition, that means we are talking about original compensation and enhanced compensation. So if we are receiving original compensation or enhanced compensation in respect of compulsory acquisition of land and building, which is a part of industrial undertaking. In short, in simple word, we can say we are talking about factory, etc. And if you are going to purchase new land and building or construct new building, out of this compulsory acquisition compensation, then you can claim exemption under section 54D. It is available to all assessee. The time period could be long-term, short-term, whatever it is. Amount of exemption, that is amount of investment. Industrial land and building was used by assessee for a period of 2 years prior to the date of transfer for business purpose. Purchase new land and building for industrial purpose and purchase construction should be completed within 3 years after the date of compulsory acquisition. Again, point number B, C, and remaining points are same exactly, which has been discussed in section 54. We also discussed 54EC, and that was in this 54EC and the other exemption we discussed section 54, 54B, and 54D. There's a difference in the nature of investment because in the earlier 3 exemptions, the transfer property and the investment property must be same nature. But in section 54EC, this has been changed. Now, you should transfer any land and building or both. It should be long-term. And you need to purchase a specified long-term capital asset as has been notified by the government. The exemption can be maximum up to 50 lakh. Assessee can be anyone. Time period only long-term, of course. And amount of exemption, that is investment in the NHAI RECL bond. The maximum limit is, of course, 50 lakh. The investment time duration is also only 6 months from the date of transfer to invest in the long-term specified asset. Newly asset cannot be transferred within 5 years, and if it's transferred, the concept has been changed. We also discussed this concept with an example in last session, that now the cost will not be reduced, but the amount which has been exempted earlier is going to be taxable. In the same nature, it was exempted. You can see that in section 54EC, there is no requirement of investment in capital gain scheme up to due date of ROI. There is no concept. There is no point number 5 and 6 exist in section 54EC. Why? The reason is the time of investment is only 6 months from the date of transfer. So there is no 2-year, 3-year benefit. So because the time limit is very short, so departments say either you invest within 6 months or your exemption will be less. So there is no requirement in the capital gain scheme, etc. If you want to invest, you can invest, but the actual purchase of bonds or debentures should take place within 6 months from the date of transfer. So till here, we discussed the provision. That was the recap of exemption, what we discussed in last session. The last exemption we have is section 54F, and this exemption has different nature actually, technically. It is different from other exemptions. First difference, of course, like section 54EC, you have to transfer something else and you have to invest in only residential house. But you cannot take exemption under section 54F. If you transfer a residential house, you can see section 54F says you need to transfer any long-term capital gain asset other than residential house. So there might be any kind of long-term capital gain except arising out of a residential house, and you need to purchase or construct a new residential house. Why residential house has been excluded from here? There is a very strong reason. Because if you transfer a residential house and purchase the residential house, we have a separate exemption for this concept under section 54. So if we include residential house over here also, then both exemption will clash. So to make exemption mutually exclusive, this provision has been made that any long-term capital asset or long-term capital gain other than the residential house. And if out of that long-term capital gain other than residential house, you bought or purchased a new residential house, then you can claim exemption under section 54. So you can see this, if there is a long-term capital gain of a residential house or other asset, and if you buy a residential house, the exemption of section 54 provision will apply. And if you transfer any other long-term capital gain asset and invest in a residential house, then we apply section 54F. It's quite simple, nothing to be confused. So any long-term capital gain other than the residential house, and if you invest in a new residential house, purchase or constructed, then you can claim exemption under section 54F. Assessee should be individual HUF. I've told you, whenever there is a land or residential house investment provision, assessee will be only individual HUF. Nature of asset must be long-term capital asset because we need long-term capital gain for it. Now the exemption is quite different. In earlier all exemption sections, the exemption is technically the amount of investment, if it is up to the amount of capital gain. Except is section 50 EC, where there was a specific limit or maximum ceiling is 50 lakh. So section 54 says there is no exemption limit. You can claim any exemption except the number of houses criteria. 54B do not have any kind of restriction. 54D do not have any kind of restriction. And as section 54 EC, 50 lakh rupees. But still, the amount invested will be allowed as a exemption. But section 54F having a proportionate exemption concept. Proportionate. You cannot claim the amount of investment directly as the exemption. No. We have to calculate a proportionate amount of exemption based on your gain and net sale consideration and your new investment in the residential house. So in short, there's a formula to calculate the exemption and amount calculation whenever it happens under section 54F. The single formula you can use to calculate exemption, taxability, etc. under section 54F. The formula is very simple. It says original capital gain upon net sales consideration into investment amount. This is a single formula. It's very important because you can solve all numerical things under section 54 AC with the help of this formula only. There is a single formula which is going to be utilized at every step where we need to calculate any amount. So for example, if you need to calculate exemption amount under section 54F, exemption value, then we need to use formula original capital gain, net sale consideration into investment. So when you multiply investment value in this formula, you will have your exemption value under section 54F, exemption. If under section 54F, any amount has been misutilized, you deposit in the capital gain scheme and you misutilized it. So in normal case, whatever is the misutilized amount, that is going to be directly taxable. But for 54F, if there is any misutilized amount, and we need to find how much is going to be taxable, again, this formula will come into the picture. So now the formula again, original capital gain upon net sale consideration into misutilized amount. So whatever value you want to find, you just need to multiply that value with this fixed value. So this denominator will remain the fixed. If you need to find the exemption, multiply it with the investment amount. If you need to find the misutilized taxable amount, you need to multiply this into misutilized amount, same. If you want to find out unutilized taxable amount, for example, you invest in that scheme 50 lakh rupees. Out of that 50 lakh, you use 40 lakh for the purpose of purchase or construction of building, and 10 lakh remains in that capital gain scheme. then after expiry of certain period, that 10 lakh is going to be taxable. So with other exemption, that 10 lakh is directly going to be taxable as gain. But again, because the exemption is proportionate, so every calculation will be proportionate. Now again, same formula, original capital gain upon net sale consideration into unutilized amount. So whatever taxable value or exemption value you need to find, you just need to multiply that amount with this basic formula. So this is our fixed formula, that is original capital gain upon net sale consideration. Just multiply it with the different kind of situation, you will get them. Okay. So this is very important formula. You should remember it. And now moving on to our provision one by one. So assessee we discussed, amount of exemption. This is the formula which we were talking about. Condition, assessee should not own on the date of transfer of original asset more than one residential house other than residential house for which exemption claimed in India. So whenever you are transferring any long-term capital gain asset, at that time you should have only one residential house with, not more than one residential house. The other residential house can be that house which is you are going to purchase for the purpose of claiming the exemption. Simple. Assessee cannot purchase within 2 years or construct within 3 years from the date of transfer any other residential house. If you have claimed the exemption by purchase or construct a new residential house under section 54F, then after that purchase of that residential house, which has been claimed under exemption under section 54F, you cannot purchase any new residential house within 2 years, or you cannot construct any new residential house within 3 years from the date of transfer. Otherwise, the capital gain exempted earlier, what will happen? You cannot purchase within 2 years or construct within 3 years from the date of transfer. After you claim exemption under section 54F for purchase of a new residential house or construction. After that, you cannot purchase any other residential house within 2 years or cannot construct any new residential house within 3 years. Otherwise, the capital gain exempted earlier will be taxable as long-term cap gain in the year of such new residential house occupied. So condition A says that suppose is this Mr. Ram who is having 2 residential house already. Now he sold his jewelry long-term, and out of the capital gain of this jewelry, he want to purchase a new residential house. So now at the date of transfer, he is already having 2 residential house. So now this exemption cannot be claimed as per condition number A not satisfied. And now suppose Mr. B is saying selling jewelry, and after selling jewelry, he bought a residential house for which section 54F has been claimed. Now, because the section 54 exemption has been claimed, so after the exemption claim, now within 2 years or 3 years, no new residential house can be purchased or constructed. If it is happening, then the capital gain exempted earlier is going to be taxable again. Now, what is the time limit for purchase of new residential house or construct new residential house? It is exactly same as section 54. If you can compare section 54 and 54F, almost all the conditions are same except few. The time of investment is same. Again, this is 1 year before the date of transfer, purchase within 2 years after the date of transfer, or construct within 3 years after the date of transfer. Condition B is same. Newly acquired house property should not be transferred within 3 years. If it is transferred within 3 years, then I have discussed you with in this last session. Then if section 54, 54B 54D is there. Then if asset is transferred before expiry of 3 years, in that case, the cost of acquisition of the asset transferred will be reduced from the amount of capital gain exempted earlier. And section 54EC and 54F. In these cases, if asset is transferred before expiry of 5 years in case of 54EC and 3 years in case of 54F, then the capital gain exempted earlier is going to be taxable again. 5 and 6 point is same. You have to deposit in the scheme or going for the actual investment up to the due date of ROI. And if amount misutilized, etc., unutilized, then again with the help of formula, you need to find the unutilized amount taxable value or misutilized amount taxable value. So these were section 54, 54B, 54D, 54EC, and 54F. Let's see if there's any query, then we can take it. Sir, what is the specific urban limit for agricultural land under section 1037? Bhumika is asking me, what is exactly urban or rural agricultural land that has been discussed with you by the faculty under chapter 3, I guess, income which do not form part of total income, exempted income. In that, there must be a concept of agricultural income in which that has been discussed with you, that what is exactly the agricultural land in urban area and rural area. Like it depends upon the population. If it is more than 10,000 population, up to 1 lakh, then that area and next 2 kilometers will be urban area. A population is 1 lakh till 10 lakh, then it is 6 kilometers, and after that it should be 8 kilometers. So that has been discussed with you. Kindly go to that session so you will be able to understand the concept clearly. Okay, so I guess this question has been asked at that session, which I skipped. So I am taking the picture of that question. So it was not available at the query portal that time. Just a second. Varsha is asking, if under construction, new house booked before the old house sale, then exemption allowed under section 54A and 54F. What is 54A? For same property can claim if total is not exceeding 2 crore and purchase value is not fulfill the sale consideration of old house. Okay, Varsha, you might be confused. Your question is, if under construction new house booked before the old house sales. So if you are selling a house, you cannot claim section 54F. 54F basic condition, you can sell anything other than residential house. So your question is technically wrong, because if you are selling an old house, and then you are asking me, can we invest in section 54F and 54A? 54A, do not know what you are asking. So 54F cannot be applicable in that case. So kindly correct your question first, then I can answer. Okay. So now there's a clarification regarding exemption we have. Section 54H. And it's not an exemption section, it is a section which gives you clarification regarding the exemptions. Now the problem arises in sections of exemption is this, the practical problem. That's why department make this section 54H to remove the difficulty. The provision says that suppose in section 54, the residential house transfer, residential house purchase / construction, and the purchase construction time period 2 years or 3 years. The post investment time period, we are not talking about the pre-investment time period. This exemption has been given for post investment time period. So you need to purchase or you need to construct a new residential house within this duration. And this duration will be calculated from the date of transfer. So that is the provision we already knew. Same in case of section 54B, 54D, 54EC, and 54F. That we need to invest. The time limit for investment is connected with the date of transfer. Clear? Now suppose there is a residential house under section 54, which has been compulsory acquired by government under section 45. So it has been compulsory acquired in 2018. And department say OC will be 50 lakh. OC will receive 50 lakh. It is not has been received in this year. It is receivable in 2018. Department does not pay it yet. They just compulsory acquired your property in 2018 and said that the OC we will give you, and that will be 50 lakh. We will give you. Assessee say okay. So the provision of section 45(5) say that if it has happened, then this will be your transfer year, 2018. But the amount of capital gain will be chargeable in the year OC as a whole or part will receive. Suppose 50 lakh has been received in 2022. Now the residential house has been transferred. An assessee in 2022 received the money and want to buy a residential house, new residential house, to claim the exemption under section 54. But the problem is this: if we literally read the section 54, it says the transfer year is 2018 and the investment in new residential house should be done within 2-year purchase, 3-year construction. That means up to 2020 or 2021, he needs to purchase a new residential house or construction. But how it is practically possible? He do not have any money in 2018. That is the transfer year for the purpose of investment. He got the money in 2022. So he practically can purchase house when he will receive the money. And because he received the money in 2022, so now he can purchase property for investment after receiving money, which is year 2022. But before even receiving the money, the time duration for investment as per section 54 language has been elapsed, has been passed, has been expired. So assessee say, I want to claim exemption, but section 54 will say, no, you cannot claim because the time duration is connected with the date of transfer, which is as per the technical meaning is 2018. So assessee say, what is my mistake? And department also analyzed that yes, in this case, there is genuine hardship on the assessee. So he cannot claim the exemption within 2 or 3 years from the date of transfer, which is 2018. So this section 54H has been inserted to solve this kind of problem, which can be in section 54, which can be in section 54B, D, EC, and F. In these cases, if compulsory acquisition or conversion of asset into stock in trade, again in that case also, you will have money at the time of you must receive money. And when you receive money, the date of transfer is something else. So you cannot claim exemption due to the chargeability year is different, the amount received, and the transfer is different. So for these cases, department has made a clarification that in these cases, the time duration will not calculated from the date of transfer, but the date of amount received. So in this example, from 2022, the limit of 2 year or 3 year, the investment in capital gain scheme, July, etc., will also be counted as assuming that 2022 is the date of transfer. So the time you receive the OC, that date will be taken as the date of transfer only for investment in these sections. Clear? So it's a very good provision, very welcome step taken by the department. to solve the problem of assessee in the investment cases. So in case of compulsory acquisition, etc., the limit for the purpose of investment under section 54, 54B, 54D, ECF will be computed from the date of receipt of compensation, either original or enhanced. So whether it's an original compensation or it's an enhanced compensation, the time limit will be calculated not from the date of transfer, but from the date of receipt. Clear? Note number 2, this is very important. This is for section 54F. It is an example also. We discussed or we solved the problem with the help of an example. It's a very, very good example for your examination purpose and for your practical problems to solve. Now the problem under section 54F is different. Let me tell you what is exactly the problem. Then you will be able to understand the example in the solution. Under section 54F, okay, fine. We are talking about the other exemption first. Like under section 54, if you are having a residential house, you transferred it, and the long-term capital gain comes, for example, rupees 90 lakh. Out of this 90 lakh, you purchased a new residential house within the specified time for rupees 60 lakh. You also purchase government NHAI bond within a specified time for rupees 40 lakh. Now the question arises, can we claim both exemption out of section 54? The answer is yes. If the condition has been fulfilled, then you can claim multiple exemption from different section under single capital gain. So we can claim section 54, that is 60 lakh, and we can claim 30 lakh out of this because already 40 lakh limit and the exemption, the capital gain left is only for 30 lakh rupees. So we can deduct up to the amount of capital gain. So that will be nil. Suppose in this example, it's 90 lakh, investment in house is 60 and 20 lakh in the NHI bond, then we will solve it like this. So there is no issue if we deduct NHI bond first or new residential house value first. It does not make any difference. The answer will remain the same. So the concept is this: always deduct the specified exemption first and then the general. So transferring a residential house and purchasing a new residential house. So specifically, this is made in section 54. So you can deduct the first section 54 exemption and then section 54 EC. So specific exemption should prevail over general. So what was I was trying to tell you that the multiple exemptions are allowed, and in both cases, whether you allowed NHI deduction exemption first and after that other, there will be no difference in your answer. That will remain the same. Clear? But the problem is this: under section 54A, if you transfer any long-term capital gain, for example, you transferred your shares worth rupees 90 lakh in the same case. Out of these shares, you purchased the residential house for 60 lakh. And you also purchase, you cannot purchase 54 EC bond because that exemption only available in case of land and building. So you invest or you purchase an agricultural land for 20 lakh in urban area or rural, how does it matter? Now we can deduct it like this, 60 or 20. And we can have our gain 10. But no, because there is a proportionate concept applicable, so we cannot deduct it like this. Now the problem is something else. Just a second. So we can not give the exemption like this because there is a proportionate concept applicable. So if we transfer shares 90 lakh and purchase residential house for 60 lakh and agricultural land 20 lakh, we need to give the exemption as per that formula, which says original capital gain upon net sale consideration into investment amount. And same for this case, original capital gain upon net sale consideration into investment amount. But the problem is this. Because the exemption is depending upon the proportionate value of original capital gain upon net sale consideration. And again, this case also. So we have multiple assets eligible for the purpose of exemption. You can allow it as per the formula value. But suppose when you have sold multiple assets, now in case we transferred shares, those are long term, we purchase residential house or agricultural land, you can give the exemption as you want. Either because this section has no specific or general concept, either you can give the exemption to residential house first and then agricultural land, or vice versa. It does not make any difference. But when the problem will arise, if this exemption will not be applicable in respect of agricultural land because section we have transferred 90 lakh and purchasing a residential house. That is only eligible under section 54. F. 54F is not applicable in this case because for 54F you have to purchase only residential house. So in this case there is no issue because this is not applicable. Only will give exemption in respect of first section 60 amount 60 lakh. But what exactly the problem will arise if situation is like this? You have transferred shares for rupees 60 lakh less index cost of acquisition. Suppose that was 50 lakh. 10 lakh was long-term capital gain. You also transferred land for 100 lakh, index cost acquisition 50 lakh, long-term cap gain 50 lakh. You also transfer jewelry in the same year we are talking about for rupees 200 lakh, index cost of acquisition suppose 120 lakh, and you are having long-term capital gain. So suppose Mr. A transfer all three assets. Suppose Mr. A transferred all these three assets, that is shares, then land, and then jewelry. Now I am going to ask you a very, very interesting question and a very simple also, simple mathematics question. Listen it carefully. If Mr. A transfer all these three assets in assessment year 23-24, okay, and having respective capital gain like 10, 50, and 80. And now if Mr. A, listen carefully, now if Mr. A wants to invest in purchasing a residential house, a new residential house. So if Mr. A wants to invest in a new residential house, out of these 1, 2, or 3 transfer value, what is the maximum amount he can invest if he do not have any other income except shares, land, and jewelry in this year? He has only these 3 incomes in assessment year 23-24 and do not have any other money. Then what is the maximum amount he can invest for purchase as a residential house. What is the maximum amount he can invest for purchase of a new residential house if he has only these three income which has been shown above? Let me make it simpler for you. Option 1, that is 360. These all figures are in lakhs, of course. Option 2, 140 lakh. Option 3, none. So if Mr. A wants to invest in a new residential house and he has only the money which has been received from above transaction, so what is the maximum amount of residential house or investment he can do? You need to just give me the answer of this question. It's very simple and it's very basic question. There is no income tax involved. There is no capital gain concept. It's a general question. Anybody can answer. Varsha, you are asking the again same thing. I have told you that you cannot claim section 54F if you sold a residential house. So in your question still, you are transferring old residential house. So you cannot claim section 54F because the transfer asset should be other than residential house. So let's see the answers. Darshan is saying 360. Madhav is saying 140. Rajiv Kumar is saying 140. Manisha is saying 1, that means I guess 360. Anisha is saying 140. So let me make it more simpler for you. The answer cannot be third. Okay. So either it's 360 or it's 140. Now you need to choose only one out of it. So the correct answer is he can invest maximum of 360 lakh rupees. Those are saying 140. It's a very simple question. Understand what you are trying to say. We do not invest gain. This is our profit. We can invest the receipt. For example, let me give you a simple example. Okay. If I bought suppose I bought a mobile phone. Or leave it. I purchased jewelry for 50 rupees. Okay, just 50 rupees. Just for an example. And I sold this jewelry for 70 rupees. So how much gain I have? 20 rupees. So I'm just asking one simple thing. How much amount in my pocket when I sold it? 70 or 20? How much amount we receive at the time of sale? It's 70 or 20? 20 is just the profit. But if I sold this jewelry, then what amount I received in my pocket? That is 70 rupees I received. And if I want to purchase a new jewelry, so up to what amount I can purchase? 70, not 20. 20 is just the profit. But we invest what we receive. So in above example, at the time of sale, he technically received 360 lakhs. So in his bank account, he is now having 360 lakhs. So we can invest this value. This is only the profit, not the value we can invest. This is just the profit, but the receipt is 360 lakh. So we can invest up to 360 lakh or always that amount what we receive, not the profit portion. Let me make it more simple. If you have a pen, you all have pen with yourself and you bought a pen for 20 rupees. Okay. You bought a pen for rupees 20. And now you sell that pen to someone for rupees 30. So now you have a gain of 10 rupees. But if you now want to buy a new pen, So we have 30 rupees. So we can buy a new pen for rupees 30. Suppose you bought that pen for 20 rupees and you sold it for 15. So now you have a loss of 5 rupees, but still you got 15 rupees. So a new pen of 15 rupees you can buy. So it always investment amount is based upon the amount received. That is consideration or net sale consideration. Profit is just showing what amount you gain or lose out of that asset, not the investment amount. So in this case, Mr. A can invest maximum 360 lakh rupees out of transferring of these assets. I hope it's clear now. Okay, so let me solve this example again. So Mr. A transferred shares. Sale consideration was 101 lakh. Now less expense on transfer. It's given in question 1. So now 100 lakh is net sale consideration. Clear? So now if I'll ask you how much I can invest, 100 lakh I can invest out of this transfer. The index cost of acquisition is given in question 70 lakh. So 30 lakh was my long-term capital gain. Clear? We also transferred that is for 500 lakh, 505 lakh. Expense on transfer is 5. It comes to 500 lakh net sale consideration. The index cost of acquisition was, suppose, 350 lakh. So 150 lakh is my long-term capital gain. Now, $90 lakh, no expense on transfer. $70 lakh was index cost of acquisition, and 20 lakh is your long-term capital gain. So now in this case, he can maximum invest 690 for purchasing a new residential house. Clear? Suppose Mr. A purchased a new residential house for rupees 600 lakh. He purchased a new residential house for 600 lakh rupees. So if I'll ask you that he transferred shares and purchased a new residential house, which exemption can be claimed? Section 54F. So shares can claim exemption under section 54F because asset is transferred, which is other than residential house, and he invests the money for purchasing a residential house. Again, jewelry is also eligible for section 54F exemption, and exactly the land also. So now these all are eligible for claiming exemption, and he technically invests the money of all these three assets for the purchase of this residential house. Now the problem arises that shares will say we want exemption section 54F, jewelry will say yes, we are also eligible, and land will also again say the same. So to whom we can give the exemption first out of this 600 lakh rupees investment? So there would not be any issue in this investment case if we do not have that formula. If this section 54F does not have this formula, then we can give exemption out of this 600 lakh to any asset in any order. You can exempt first of all 30 lakh gain, then 150, and then 20. It does not matter. But the problem is this formula, and its formula having a special character. It says, I will give you exemption depending upon your original capital gain and net sales consideration proportion. So to find out to whom we should give the exemption first, and then second and third, we need to do a ranking concept, and that is only applicable in section 54F. And why it is applicable? Due to this formula. And for the purpose of ranking, again, we will use that formula, original cap gain upon net sale consideration into 100. This will find the percentage value for the purpose of exemption order. So if we'll find this formula, apply this formula on transfer of share, the percentage will be 30%. So the proportion of capital gain we can exempt if we invest in shares will be 30%. So if we invest 1 rupee in shares, then we will get the 30% exemption only out of the capital gain. That is 30 paisa from 1 rupee. So this percentage is showing how much capital gain you can exempt if you'll invest in these properties. So if you invest 100 rupees, you will only get the exemption of 30. Same, we will apply the same formula in case of jewelry. Its percentage is again coming the same. So I'll change this. Let's make this value is 400 and this will be now 100. Fine. So because that was also coming 30% and I wanted different percentage to make you understand. So now this is 20%. So if you'll invest in jewelry of 1 rupees amount of investment, you will only get 20 paisa of exemption. Now the land case. Now the exemption is 22.22%. So if you invest money in this, you will get the exemption of 22.22%. So now the maximum percentage will give the exemption first. Then we will provide the exemption this second. And then in last, we will provide the exemption to jewelry. So this is the order we need to find. If there's multiple asset has been transferred, and in that case, if invested in a residential house, then we need to find out the ranking order. And to find the ranking, we have to apply again this formula. After finding the ranking, now we can give the exemption as per the ranking order. So first of all, under section 54F, for the purpose of exemption, the formula is again original capital gain upon net sale consideration into investment amount. We will apply this formula on first case. Original capital gain is 30 lakh. Net sale consideration is 100. And investment in 600 lakh. Total investment is 600 lakh. So in this 600 lakh, what is the maximum amount we can invest out of our shares value? The maximum amount can be maximum value, that is net sale consideration. So maximum investment cannot exceed the net sale consideration. So out of this 600 investment, shares investment can be maximum 100. Because that is our net sale consideration. So do not write 600 over here. It will be wrong. We need to find from each separate asset what can be the maximum investment we can do. So from shares, we can do the maximum investment, that is your net sale consideration. So full 30 lakh will be your exemption and your gain will be nil. Because your long-term capital gain was 30 lakh, investment was exemption is 30 lakh, so gain will be nil. But you utilize 100 lakh. So remaining investment is now 500 lakh. So now second ranking is for land. We will apply the same formula over here. Original capital gain upon net sale consideration. Again, from this 500 lakh investment, what is the maximum amount of investment we can make from the land? That is, of course, 90 lakh. We cannot invest more than that in this. So now the exemption will be full 20 lakh. Gain was 20, exemption is 20, so capital gain will remain nil. So now we have left only 410 lakh rupees investment. And the third ranking is for jewelry. original capital gain is 100. Net sale consideration was 500. Now do not write it 500 over here. We have a practice that because we wrote this net sale consideration over here, and again this net sale consideration was here. So generally what student does in examination, we generally write 500 over here directly. That is the thing what examiner actually see. That either you understand the provision or you just read the provision and do not understand the concept. So 500 is the value what we receive, but we cannot write down 500 total because we invest only 410 lakh rupees out of this 500, because total amount received was 690 and we invest only 600. So we did not invest the full value out of this 500. The balancing figure will come over here. So net sale consideration is 500. He could invest 500, but because the consideration was 690, but we invest only 600. So that means out of that 600, shares investment 100, land investment 90, balance 410 is only can be as an investment from this jewelry value. So now we will have our exemption. So now this come 82 lakh. So now in this case, long-term cap gain was 100, exemption is 82, so taxability is only 18 lakh. So in the examination, it will always happen that if there is 3 or 4 asset has been eligible for the purpose of section 54, then might be out of these 3, 2 exemptions will be full exempted. 2 capital gain will be fully exempted because the investment value will be equivalent to your net sale consideration. But the last value what you are claiming is an exemption will not be fully exempted. If examiner says that he purchased a new house for 690 lakh, the full value has been exempted, then automatically over here we will write 500 and there will be no capital gain. But examiner will not do so because it will be very simple for you to solution. So he will see either you are going to take full value in the last case or you understand the provision like this. So you are just using the balance value. So always in examination, if question regarding section 54F is coming and there are multiple assets, those are eligible for exemption, always use this calculation at your working note. Whatever exemption you have given for any asset, deduct it from that value and then deduct it. So you will not get confused and the remaining value only you will use for the purpose of exemption in the last asset which is eligible for the exemption. So that's why section 54F according to me is most important exemption out of these 6 exemptions. If there is multiple asset eligible for the purpose of section 54F, you have to see carefully that ranking should be done. Exemption should be provided as per the ranking. And when you are giving the exemption to the last asset, always remember there must be the balance value which should be written at the time you solve the last asset which is eligible for exemption. I hope it's clear. I have also solved an example in your notes regarding exactly the same. There were 3 assets. I have prepared an example for your purpose. There is now 4 assets: jewelry, shares, capital index bond, and land. We have the net sale consideration, capital gain. We have to do the ranking. We have done the ranking. It is claimed 10%. This is 40%, 20%. This is 75%. So 75 will claim the exemption first, then the 40% will claim the exemption second, then is 20%, last is going to claim fourth. And you can see the balance figure we use 370 lakh because out of this exemption you will see total maximum investment we could done out of these will be 670 lakh. If you can see in this question, the maximum investment in residential house could be 670 lakh, but he invests only 540 lakh. So you give the exemption in first case full exemption, second case full exemption, third case full exemption, because the net sale consideration and investment amount is same. But in the last case, the balancing figure can be claimed as exemption. I have also shown this over here, the balancing figure, and the capital gain taxable should be only 13 lakh, which has come from the last asset used for the purpose of exemption. I hope it's clear. Clarification regarding section 54, which we have already discussed. So exemption has been over. Now let's see if there is that. Stable. Okay. Okay. Net problem was there, but now it's clear, I guess. Okay, Varsha is now asking a problem. If under construction house booked in July 2022, okay, and old house sold in June 2023, okay, and other old house in 2023-24, can long-term gain from sale of both old house can be claimed exemption if total long-term gain is less than? Yes, you can do this, of course. If the condition of section 54 is fulfilled, then you can claim the exemption. Okay? And I guess your question is still not clear because, okay. Moving on to our computation of capital gain and exemption part, in which we have discussed the exemptions part, and now we are left with our calculation of tax provision. So we have different nature kind of capital gain under long term and short term. We already discussed the provision regarding these sections and these kind of gain. We are again revising it, and then we are moving it to a detailed concept of how to calculate tax on capital gain, etc. So first of all, section 111A, computation of tax on short-term capital gain on equity shares or units or equity-oriented fund under section 111A. We have discussed section 112A also. That is for long-term capital gain or long-term capital asset. So if section 112A regarding the long-term capital asset, if they have been sold from after paying STT and sold from recognized stock exchange, then tax at the rate of 15% is applicable under section 112A long-term capital gain. And if these assets are short-term, then the gain under section 111A is going to be taxable, and the rate of tax will be 15%. The provision says like this: if you have equity shares, equity oriented fund on transfer, you have paid security transaction tax. So now if these are long term, they will fall under section 112A. If these are short term, they will be under section 111A. So computation of tax on short-term capital gain on equity shares or units of equity-oriented fund under section 111A. Transfer should be on or after 1st October 2004. This condition is irrelevant because automatically the transfer year will be this year only. STT has been paid and transfer made through RS, that is recognized stock exchange. Then on above short-term cap gain, tax rate will be 15%. So the tax structure provision, what we are discussing right now, I am just reading it with you and I am just trying to make you understand. Do not worry, after this, I will make a chart also, then it will be really easy for you to understand. So we just need to read the provision and read the concept and going to understand it right now. But the whole procedure will be able to understand you more easily with the help of a diagram after this discussion. Adjustment of unexhausted basic exemption limit. So the basic exemption limit is 2.5 lakh, 3 lakh, and 5 lakh, as the case may be. Okay. When we will discuss our MCQ today or test your knowledge question, so please have a paper, pen, calculator, and capital index with you. The capital index from 2001 to till now. You should have that value with you also, so it will be easy to you to apply the index on the provision, or you can solve it more easily. Okay. So in examination, it will be given, but for now or for today, for test your knowledge and MCQ, you should have that sheet with you. So in the case of resident individual HUF, if the basic exemption is not fully exhausted by any other income, then such short-term cap gain also eligible for that 2.5 lakh or 3 lakh rupees exemption limit, or 5 lakh rupees, as the case may be. The balance is going to be 15%. That's what I'm saying. If you're not able to understand how that exemption limit will be availed by short-term capital gain 111A, I will let you explain with the help of a very simple diagram. You should understand what is section 111A. If these conditions fulfill, section 111A is applicable. What is the tax rate upon it? 15%. It can claim an unexhausted basic exemption limit. How it will be applicable, implement, I will let you know. But you should just understand this time one thing, that exemption limit it can claim, tax rate will be 15%. It will arise when there is long-term, when there is equity shares or equity-oriented fund transferred through recognized stock exchange, paying STT. No deduction in section 80C to 80U will also allow. They cannot claim deduction in section 80C to 80U also. That is called chapter 6A. So point 2 also say this, that no reduction under chapter can claim out of this short-term capital gain under section 111A. I will let you explain. Do not worry, just relax. I will explain how it is going to be claimed. Other short-term cap gain will be chargeable as person-wise rate. Again, you should not get confused. What is person-wise rate? What is other short-term cap gain? Other short-term capital gain, that means other than section 111A. For example, if you are selling any property before 24 months, that is land and building. After 24 months, it is long term. Before it is short term. So if there's short term, that is called other short term. If you are selling any other property, which is not a long term capital asset, that gain will be short term cap gain. So any other gain which does not fall under section 111A, and if it arises on a capital asset which is short term capital asset, then that is going to be taxable as per basic rate or other rate. What the other rates? I will explain you just a second. Water bottle has been. Okay. Now we are talking about long-term capital gain. So we have normal long-term capital gain on normal asset, and we have specific long-term capital gain in section 112A also, where the total income of an assessee includes long-term capital gain. Tax is payable by the assessee at 20% on such long-term capital gain. Slab rate does not applicable on it. It's a fixed rate of taxability, that is 20%. The treatment of long-term capital gain in the hands of different type of assessees are as follows. Income tax payable at normal rates on total income as reduced by long-term capital gain plus 20% on such long-term capital gain. However, where the total income as reduced by such long-term capital gain is below the maximum amount which is not chargeable to tax, then such long-term cap gain shall be reduced by the amount by which the total income as so reduced falls short of the maximum amount. Again, do not get confused. It's again talking about the basic exemption limit. If you have basic exemption limit left with you, then first of all, we will reduce that long-term capital gain with the help of this basic exemption limit and then apply a rate of 20%. And as told you earlier, do not get confused. Do not panic. I will explain you with the help of an example and diagram also. Just read it with me. This second provision is new. Lower rate of tax, new means what we did not discuss yet. It not new means it's an amendment. No. Department or income tax provide an option to you in case of listed security and zero coupon bond. You can only claim this benefit in respect of listed securities and zero coupon bonds. And it says, where the tax payable in respect of income arising from the transfer of a listed security or a zero coupon bond being a long-term capital asset. So first of all, you should understand this is only applicable in case of listed security and zero coupon bond. In that case, department gives you an option. And the option is this. Option 1 and option 2. If you are transferring listed security or zero coupon bond, then you have option to pay tax as per with the help of indexation or without the indexation benefit. Because we know on security we can take the benefit of indexation. So if it is happening, in that case, you have to calculate your capital gain twice with the help of indexation and without the help of indexation. The long-term capital gain on transfer of units and unlisted security are not eligible. Only the eligibility is with listed security and zero coupon bond. And this is how we need to calculate it. There is no new provision of calculation, the same. You just need to calculate the capital gain twice. Option 1 says, find the sale consideration, deduct index cost of acquisition or index cost of improvement. Whatever is your long-term cap gain, apply the rate that is 20%. We all know that long-term capital gain is having a rate of 20%. Option 2, sale consideration, now deduct cost without indexation. Deduct improvement without indexation. So your gain, of course, will be higher in this case. In this case, because you index the cost, so your gain will be lower, but the tax rate is 20%. And in this case, your gain will be higher, but the tax rate is 10%. So these two tax paying option is there. You can choose any, whichever is lower. For example, I can say that suppose the sale consideration is 1 lakh. The cost of acquisition was 20,000. And with the help of indexation, index cost of acquisition is 60,000. So now if this is a case of listed security or zero coupon bonds, then what we will do, option 1 we will apply like this, sale consideration, and option 1 we deduct the index cost of acquisition. So our gain will be 40,000. 20% tax, that is 8,000 tax. Either you want to pay, you can pay 8,000, or second option, 1 lakh your sale consideration. Cost of acquisition is, we should take it like 30,000. 30,000 was the cost acquisition. Now 70,000 is gain. And the tax rate option is 10%, that is 7,000. So in this case, we can opt this option second because tax is reduced, that is 7,000. So you have the option to apply any kind of tax depending upon which you are getting lower rate of tax. No deduction you can claim out of long-term capital gain. Adjustment of unexhausted basic exemption limit. Same case, it's saying that if the basic exemption limit is remaining with you, then you can claim the exemption out of this basic exemption limit. Clear? No deduction of section 112A also. No benefit under section 87A, the rebate. You cannot claim rebate out of capital gain under section 112A. This is special provision. You should remember always. Rebate can be claimed out of any income tax, but cannot claim under section 112A tax. 112A was when you transfer your equity shares or equity oriented fund. And if that is long term and STT has been paid, then that is section 112A, long term capital gain. You cannot claim exemption. You cannot claim deduction under section 80C to 80U. You cannot claim rebate, but the basic exemption you can claim, that is unexhausted limit, you can claim out of this. So these 2 pages might be, these 3 pages might making you confused regarding the tax rate, etc. Do not worry, I have the solution for you. Just relax and see this. With the help of a diagram, you understand what exactly we are talking and how we are going to solve it. Lot of confusion and queries will be solved with this help of example. This chart has already been uploaded on the portal also. In chart part 2, this chart is also there, but we are discussing that chart in detail over here. This will really help you in calculation of tax. So now we know we have one thing that is called gross total income. We all know that. The gross total income generally consists 5 heads of income, of course, that is salary head, income from house property, then PGBP, then capital gain, and income from other source. Under capital gain, either it will be section 112A, long-term capital gain. It can be section 11A, short-term capital gain. Other long-term capital gain, 112. Other short-term capital gain, except 111. In income from other sources, there is casual income. Casual income is those income which depend upon your luck, which majority depends upon your luck, like winning from lottery, game shows, betting, etc. What exactly it is, that is the concept under chapter income from other source, and we will discuss in detail when I'll be taking session for income from other source and others like interest income, dividend, etc. The short-term capital gain under section 112A having a specific rate of tax. That's why I have actually bifurcate this capital gain and income from other source. So 112A is a taxability rate is 10%. They does not tax at per slab rate. It is a specific tax rate of 15%. It is a specific tax rate of 20%. Normal rate. PGBP, normal rate. Normal rate. Normal rate. Casual income, specific rate, 30%. Normal rate. So this is just to show you that your gross total income on the basis of rates of tax is different income consist under gross total income. Now for the purpose of this calculation, what I'm trying to make you understand, for the purpose of calculation, if we have this gross total income, so we understood that the gross total income consists of income. Those are taxable at specific rates. Some incomes are taxable at specific rate and others are going to be taxable as per normal rate. What is this normal rate, etc.? Now the main diagram and chart comes. So whenever you need to calculate tax, always use this diagram or chart. That will really help you. So we know that gross total income including salary, house property, PGBP, capital gain and income from other sources. The aggregate of this is my gross total income. So if you need to calculate the tax, you need to divide this gross total income as per different rates of income we just discussed above. So there is casual income. So whatever is the casual income in my gross total income, in this value, I will separate it from that value. My casual income, then long-term capital gain under section 112A. That is separated from GTI because it is having a separate rate of tax and we are solving it for the purpose of resident. Provisions are for resident. Clear? So 112A need to be separated. Then we have short-term capital gain 111A needs to be separated. Then we have other long-term capital gain. It need to be separated. And then remaining income. We can say others. What is remaining from GTI will be either, or we can say it is a balancing figure. If I'll ask you that in this other, what income has been there? It is salary, house property, PGBP, capital gain, only short-term capital gain other than 111A. Because long-term is over here and over here. Short-term 111A is here. So other short-term capital gain is over here. And out of income from other source, that is interest income, dividend, etc. Except casual income. So the balancing figure will tell you the aggregate of these income. That will be over here. So now whatever is your balancing figure total is, you can claim deductions under section 80C-80U out of this balance figure only. This balance figure is not my taxable income. After deduction, now that will be my taxable income. So now you can see, because we can only deduct the deduction part from 80C to 80U from other. That means deduction is not available from long-term this, short-term this, long-term this, casual this. So when we were reading the provision, separately in every section it has been written, you cannot claim the deduction. So now you can see with the help of diagram, now you know that from which part I need to deduct the deduction under section 80C till 80U. Clear this thing? Now the rate of taxes. Casual income is fixed taxable. Whenever I am writing fixed, that means you cannot claim the basic exemption. So casual income cannot claim the basic exemption. It's fixed with the rate of 30%. So for example, if Mr. A having 2 lakh rupees casual income only in his previous year, only casual income 2 lakh, no other income, and he is an individual, he cannot claim the basic exemption of 2.5 lakh rupees out of this casual income. So his tax will be 30% directly on this 2 lakh rupees. That will be 60,000. So you cannot claim basic exemption limit. So when I am writing fixed word against any income, that means it cannot claim the basic exemption limit. Okay. Then 112A is going to be taxable at the rate of 10%. But no rebate. Whatever tax we will derive from long-term capital gain under section 112A, we cannot claim rebate under section 87A out of this, which was 12,500, etc. So rebate cannot be claimed out of long-term capital gain under section 112A tax. Rate is 10%. Whatever your rate tax will be, you cannot claim rebate out of it. If it is still there, you cannot claim it. But basic exemption can be claimed because I did not write fixed. Short-term capital gain tax rate is 15%. Did not write fixed, that means exemption can be claimed and rebate can also be claimed. Other long-term cap gain is 20%. Exemption can be claimed, rebate can be claimed, and rate is specified. Now, this taxable income is going to be taxable person-wise. In the first chapter, you must have read the provision regarding 2.5 lakh exemption, 5% tax rate, 20% tax rate, 30% slab rate, etc. So that whole scenario is only applicable on this value, this. Not on these 4 things, because these are specifically taxable having their separate rate. If this is A, this is B, this is C, this is D, and this is E. Then we are talking about E is the income, the taxable income come out of that E part is going to be taxable as person-wise. For example, if this is a partnership firm, then it is going to be taxable at 30%. If it's a company, it's going to be taxable at 25, etc. Even you are a company, the tax rate will remain the same on A, B, and C and D case. And if you are an individual, less than 60 years of age, resident, then 2.5 lakh free. After that, 5%, 20% concept will be applicable. So this value is going to be taxable as per person-wise, not the other values. I hope you understand this. And with the help of this diagram, now you have almost all the provision you know. If somebody is asking rebate is not claimed out of which income, you can say out of this. If somebody is asking exemption, basic exemption cannot be claimed out of which income, you can say out of this. If somebody is asking what is the tax rate of different structure, you can tell this. If somebody is asking, somebody is your examiner, of course, okay, that deduction under section 80C to 80U cannot be claimed out of which income, you can write down A, B, C, and D case. So this is a summary of all tax implication provision, and it will really help you to understand or to even write the theoretical provision also, because now you know the tax rates, the exemption limit concept, who cannot claim the deduction, who cannot claim the rebate. Let me give you a simple example to solve this question. For example, there is Mr. A, who is a resident, aged 40 years, having income, PGBP income is suppose 2 lakh. Short-term capital gain on building, sale of building is 30,000. 0.30 I written, that means 30,000. Long-term capital gain on building 3 lakh rupees. Casual income 1 lakh. And I ask you to solve this question. So you just need to do one thing. In examination, you can make this diagram and you can put the value where you want to put it. Okay, there's a deduction also under section 80C, suppose that is 50,000. You do not bother about the solution, just follow what I'm saying. Just do one thing. Always make this diagram, whether the income has been given or not. You have to make 5 parts. First of all, we need to write it down. Casual income in casual income part, that is 1 lakh. Long-term capital gain over here, that is 3 lakh. Then short-term capital gain on building, that will form part of my other income, 30,000. Then PGBP is 2 lakh, that will fall my other income part. Now this is 2,30,000. Deduction we can only claim of this income 50,000. So this is now 1,80,000. So my other income is 180. My long term is 3 lakh. My casual is 1. Now we have a basic exemption limit of 2,50,000 in this case. Clear? Out of this 250, 180 is going to be utilized over here. So this value is 0. The remaining exemption we have 70,000. So 70,000 I will claim from long term. So the remaining value will be 2,30,000. Long term, which is going to be taxable at the rate of 20%. So the tax from this is 46,000. Casual income tax rate is 30%. So tax will be 30,000. 76,000 my tax. Surcharge will not be applicable. 4% cess you can applicable. And then that will be my answer. No rebate because income exceeding my TI exceeding 5 lakhs. In that case, no rebate can be claimed. Okay. So this is the way you need to solve this question. It will be really, really easy if you'll apply this format, because in this case, you just need to put the income at the right place, A, B, C, D, and E. And then you can see if you know the rates of applicability, then it will be really easy to solve. Very, very simple to solve. Let's take one more example. If you have a long-term capital gain under section 112A for rupees 4 lakh, no other income. In that case, you can take the exemption of 2.5 lakh rupees basic exemption. So your long-term capital gain will remain 1.5 lakh. The tax rate is 10%. So on that will be 15,000. And now income is less than 5 lakh, but you cannot claim rebate because the rebate is not applicable on this part. So 15,000 plus cess, 4% you add, and that will be your tax. This is the most easiest way to calculate tax. This is the most easiest, simplest, and I can tell you the most easiest way to solve this question. And the probability of the correct tax is very, very, very high in this case, because everything is so sorted that you just need to put the value and you will find the final tax liability out of this format. I hope it's clear for all of you. So you can see that I have written over here also for resident individual HUF, STCG except 111A income will be taxed as per person-wise slave. Long term 20% basic exemption limit. So all these point number 1, 2, 3, 4 will be very easy if you will read the chart first and then you will read it. For non-residents, I will explain the chart after the break. So till the resident provision, resident and individual and HUF. The provision we just discussed how to calculate the tax. The provision regarding the non-resident, that is going to be discussed after the short break. Let me see if there's any query. I will take it and then we will go for the break. Rebate also get to other income. Yes, you can claim the rebate. Rebate can be claimed for any income except the long-term cap gain under section 112A. You can claim the rebate on casual income also, except under section 112A, you can claim rebate out of any income tax. Okay. So, Manish ji, can we go for a break for 10 minutes? Okay, welcome back, everyone. So we just discussed the taxable rate provision for how to calculate the tax liability in case of resident, individual, HUF, etc. We left with the non-resident concept also. Okay, somebody's asking question. Can we claim rebate out of casual? Yes, Mohammed, I've told you that yes, you can claim the rebate. No problem in that. And this deduction of 2,50,000, Bhumika is asking, is for all income except long-term capital gain. No, Bhumika, deduction, it's exemption first of all. Do not name it like a deduction. It's a basic exemption of 2,50,000 is for all income except long-term cap gain. It is except casual income. The 2,50,000 basic exemption can be claimed out of long-term capital gain also in case of resident. In case of non-resident, it is not available from that income. Okay. And any other query? Okay, so no query left. So moving on to our story time, of course, and our fourth part of that tortoise and rabbit story was left. So if somebody is interested in hearing this story, let me know. Otherwise, we will move on to our next provision. The provision regarding, so that was regarding the resident, individual, etc. And now we will discuss the non-resident concept. In case of non-resident, almost same provisions are there. First of all, remember, no rebate out of any tax. Non-resident cannot claim the rebate. No rebate available. Then again, your GTI, whatever it is, we need to bifurcate it as a casual income, long-term capital gain, short-term capital gain, other long-term capital gain. This is our other income. Again, out of this, we can claim deduction under section 80C-80U. This is my taxable income, going to be taxable as person-wise. So this diagram is already been uploaded in the chart. I guess the chart number 2, what I uploaded on the last page, this diagram is already made for both resident and non-resident. Okay. The rate is for 20%. That is fixed. Fixed means you cannot claim basic exemption in this case. This is 15%. This is also fixed. This is 10%. This is also fixed. So rebate under section 112A concept is not applicable because rebate is not applicable in any case if you are a non-resident. And now the basic exemption only available out of this income, other income. The other income cannot claim the basic exemption in case of non-resident. So there's a just a slight difference between the provision regarding resident and non-resident, and that was over here. That was resident calculation, and this is for non-resident. So we discussed the taxable provision also. Now we are left with our MCQ and the test your knowledge questions. And let's see if somebody is interested in hearing the story, then we can go for it. Okay, Madhav want to know the story, and Vaishali also. So it's the story time is like this. First of all, the fourth part of that rabbit and tortoise story. First part, we all know that tortoise win, rabbit lose. You understand? We should not be overconfident. तो ये समझ आया, overconfident नहीं होना है. Tortoise को पता चला, do your best, and उसके बाद destiny can help you only in that case if you are doing your best. Second race, rabbit को अपनी mistake से पता चला. He learned from his mistake. He did not sleep. He did not take rest anyone and tortoise को पता चला कि हर बार सामने वाला सेम गलती करे पॉसिबल नहीं है एंड आपके पास कोई बैकअप प्लान होना चाहिए. थर्ड केस, टॉर्टोइज ने दोबारा से रेस के लिए ऑफर किया, रास्ता चेंज किया, तो डिफरेंट रूट फॉर दैट. उसमें एक छोटी सी रिवर थी और ऑफ कोर्स रैबिट उसे क्रॉस नहीं कर सकता था. टॉर्टोइज धीरे धीरे आया, क्रॉस करा और जीत गया. दैट मीन्स कि आपको अपनी स्ट्रेंथ और दूसरे की वीकनेस पता होनी चाहिए. नाउ द फोर्थ पार्ट इज, नाउ क्योंकि 3 रेस हो चुकी हैं, टॉर्टोइज और रैबिट दोस्त बन गए, हमने समझ आया कि फाइन कंपटीशन अलग चीज है बट लड़ने का कोई फायदा नहीं. फाइटिंग इज डिफरेंट फ्रॉम कंपटीशन. अब उसी जंगल में एक बंदर था जो बहुत नॉटी था, वो सबको परेशान करता और वो ये सबको देखा. उसने फर्स्ट रेस भी देखी दोनों की, सेकंड भी देखी और थर्ड. उसके बाद वो आया और दोनों पर हंसने लगा कि ये क्या ड्रामा है, तुम लोग आपस में दूसरे को हरा सकते हो, मुझे नहीं हरा सकते. और टॉयज और रैबिट ने कहा नहीं, हम तुम्हें हरा सकते हैं बट कंडीशन ये है कि तुम्हें हम दोनों को हराना पड़ेगा. मंकी ने सोचा कि अफकोर्स मैं रैबिट से तेज नहीं भाग सकता, लेकिन रैबिट रिवर पार नहीं कर सकता. इवन वो मुझसे पहले रिवर पर पहुंच जाएगा, लेकिन मैं रिवर पर पहुंच के उसे स्विम कर दूंगा, बिकॉज मंकी थोड़ा स्विम कर सकते हैं और रिवर बहुत छोटी है. मैं स्विम करके क्रॉस कर जाऊंगा तो रैबिट को तो ऐसे हरा दूंगा. दूसरा, टॉर्टोइज बहुत स्लो है, मैं तो उस रेस में बहुत पहले पहुंच जाऊंगा आगे रिवर को और उसे धीरे धीरे क्रॉस करूंगा. वो स्विमिंग में उससे फास्ट है बट रनिंग में नहीं. तो रनिंग में पहले पहुंचकर स्विमिंग धीरे धीरे करूंगा तो भी उसे क्रॉस करके जल्दी पहुंचा. तो मंकी ने ऑफर किया, यस मैं तुम दोनों को हरा दूंगा, लेकिन अगर हरा दिया तो बाकी सारी लाइफ तुम लोग मेरी सेवा करोगे, मैं कोई काम नहीं करूंगा, तुम लोग मेरी सेवा करो. और अगर मैं हार गया तो मैं तुम दोनों की सेवा करूंगा, सारे काम मैं करूंगा. रैबिट और टॉर्टोइज ने डिस्कस किया आपस में और कहा डन. अब रेस शुरू हुई और हुआ क्या, मंकी ने जब स्टार्ट करी रनिंग, उस वक्त टॉर्टोइज बैठा रैबिट के ऊपर और टॉर्टोइज और रैबिट जल्दी से भागा, टॉर्टोइज के ऊपर बैठा तो मंकी से आगे निकलकर पहले पहुंच गया रिवर पर. जब रिवर आया तो टॉर्टोइज रिवर में स्विम कर रहा था, रैबिट उसके ऊपर बैठा और वो रिवर भी स्विम करके क्रॉस कर गया. Look, hypothetically do not think कि रैबिट कैसे बैठेगा, इट जस्ट ट्राइंग टू मेक यू अंडरस्टैंड. तो मोरल ऑफ द स्टोरी ये है कि आपको अपनी स्ट्रेंथ और वीकनेस के साथ अपने दोस्तों की स्ट्रेंथ और वीकनेस भी अगर पता है तो वो बहुत हेल्प करती है लाइफ, बहुत. जीतने के बाद मंकी ने कहा ठीक है, अब मैं तुम दोनों की सारी लाइफ सेवा करूंगा, तुम लोगों को कुछ नहीं करना पड़ेगा. दोनों ने मना किया, नहीं. कहते हैं हमें सिर्फ ये प्रूव करना था दैट ओवर कॉन्फिडेंट नहीं होना है, सब लोग बराबर होते हैं और हमें हेल्प नहीं चाहिए. वी आर इंडिपेंडेंट, हम चाहते हैं कि हम सारी लाइफ काम करें. अगर सारे काम मेरे आप करोगे तो वी विल बी लेजी और हम कुछ भी नहीं कर पाएंगे. सेम वे हमें सब कुछ अपने हार्डवर्क से अचीव करना चाहिए. दैट इज रियली इंपॉर्टेंट इन आवर लाइफ, बहुत ही जरूरी. तो अपने दोस्तों की स्ट्रेंथ और वीकनेसेस पता होने से हम टाइम आने पर उनकी स्ट्रेंथ से बेनिफिट ले सकते हैं और उनकी वीकनेस पर उन्हें सपोर्ट कर सकते हैं. जैसे मुझे कहना चाहिए कि सबसे 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 जो डेंजरस लोग हैं, सबसे डेंजरस पर्सन जो होता है ना, वो होता है जो फ्री होता है. फ्री पर्सन इज द मोस्ट डेंजरस थिंग दिस वर्ल्ड. बिकॉज जो फ्री होता है ना, एक तो वो खुद फ्री है, इज नॉट डूइंग एनीथिंग, और जो उसके आसपास के लोग काम करें ना, उन्हें भी मिसगाइड करते रहते, उनसे भी कहता है कि तुम मत कुछ भी मत करो. तो जो भी आपके आसपास ऐसे लोग हैं, ऐसे दोस्त हैं आपके या जो भी हैं जो बिल्कुल फ्री हैं, जो ये कोर्स नहीं कर रहे, जो कुछ भी नहीं कर रहे, उनकी जो कंपनी है वो बहुत डेंजरस है. कंपनी ऐसी बनाई है जिससे आपको सपोर्ट मिले. बिकॉज अगर कोई फ्री है, उसके पास टाइम है, आप पढ़ रहे हैं तो वो आपको बोलेगा चलो घूमने चलते हैं. चल क्या करेगा पढ़कर, क्या बनेगा सीए होके, बाद में पढ़ लेना. तो वो दैट माइट किल योर डिजायर टू स्टडी, दैट माइट किल योर ड्रीम ऑल्सो. So be stay away from these kind of people. These are really really dangerous, right? दूसरा, पढ़ाई के लिए I just need to tell you one thing, that you should go for revision. As I always say in my class, that एग्जाम आने से पहले कम से कम दो बार कम से कम आपको रिवीजन करना है अपने सब्जेक्ट. प्लीज इंस्टीट्यूट के जो पोर्टल पे मॉक टेस्ट दिए हैं उनको प्लीज करो, बहुत जरूरी है, बहुत अच्छे क्वेश्चन है. स्टडी में से कुछ भी मत छोड़िए, सारे क्वेश्चन कीजिए, पूरी स्टडी बेस पढ़ाई करो, कोई सिलेक्टेड पढ़ाई मत करो. दैट विल डेफिनेटली गोइंग टू हेल्प यू in clear your concept also and making your study more strong for examination purpose, because institute will ask question from your study material and from every chapter almost. So do not leave any chapter. Clear? Okay, Vishwanatha Reddy, you sent one question day before yesterday, so you kindly please send me again, because there was a problem in the portal, so it was not saved over here. If you send me, I'll solve it for your next session. So now that was the fourth part of the story, and a new story for all of you. It's very inspiring also. एक पर्सन थे और उनकी जेब में कुछ पैसे थे, like 5,000 रुपए only left with him, and और किसी तरह से कोई फाइनेंशियल हेल्प नहीं थी उनके पास, उन्हें जॉब करनी थी, तो वो इंटरव्यू देने एक कंपनी में गए जॉब के लिए, एज अ पोस्ट ऑफ क्लीनर, एज अ पोस्ट ऑन पियोन। और बहुत सिंपल सी जॉब थी, बहुत छोटी सी जॉब थी, और उनका इंटरव्यू हुआ, उनसे पूछा गया और वो सिलेक्ट हो गए। सिलेक्ट होने के बाद उनके जो ऑफिसर थे, जो बॉस थे, उन्होंने कहा यू आर सिलेक्टेड, एंड हम आपको एक ईमेल से अपॉइंटमेंट लेटर भेजने का हमारा पॉलिसी है कि हम एक ईमेल से आपको लेटर भेजते हैं, तो अपना ईमेल एड्रेस दीजिए, हम आपको एक लेटर भेज देते हैं अपॉइंटमेंट का, दैट्स डन। और उसके पास कोई ईमेल एड्रेस नहीं था तब तक। उसने कहा मेरे पास ईमेल एड्रेस नहीं है, तो उसकी जॉब कैंसिल हो गई और उसकी जगह जो दूसरे लोग कैंडिडेट थे उनमें से किसी एक को जॉब ऑफर हो। ही वॉज वेरी डिप्रेस, वॉज वेरी सैड, ये जॉब भी नहीं मिली, हाउ आई विल सर्वाइव। तो उनकी जेब में जो पैसे थे 5,000 कम कर देते हैं 1,000 रुपए। उसने कहा इसका क्या करूं, तो वो एक मार्केट से जा रहे थे, देखा वहां मार्केट में बहुत सारी वेजिटेबल्स हैं, और जब वो अपने इंटरव्यू के लिए जा रहे थे तो बीच में उन्होंने देखा एक कॉलोनी थी जहां से लोग शॉपिंग करने के लिए काफी दूर मार्केट में आते थे वेजिटेबल्स खरीदने के लिए। ऐसे ही उन्होंने सोचा चलो यही कर लेते हैं, तो उन्होंने उस मार्केट से 1,000 रुपए की वेजिटेबल्स खरीदी, और जिस कॉलोनी, जो कॉलोनी काफी दूर थी, वहां जाकर उसे सेल कर दिया। तो वो 1,000 की 2,000 में बेच दी, लाइक इन 1 or 2 hours he earned 1,000 rupees। उसे लगा इट्स अ गुड थिंग, वापस से मार्केट गया, फिर से 2,000 रुपए का सामान खरीदा, वापस से बेचने गए, तो वो 4,000 में सेल हुआ। नेक्स्ट डे 4,000 का खरीदा, 6-7,000 में सेल हुआ, एंड धीरे 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 करके उसकी सेल बढ़ने लगी। इस मार्केट का होलसेलर बन गए, ट्रक्स खरीद लिए, सप्लाई ऑफ दिस चेन, इस बिजनेस में भी अदर बिजनेस में, और काफी पैसे कमाए। आफ्टर दैट एक दिन डिसाइड करा कि चलो लाइफ बहुत अनसर्टेन है, अपना इंश्योरेंस करा ले। क्योंकि इंश्योरेंस एजेंट को बुलाया और अपनी इंश्योरेंस के बारे में डिटेल दी, उसने सारी डिटेल ली, पेमेंट लिया, और बोला सर हम आपको अपनी इंश्योरेंस पॉलिसी ईमेल से भेज देंगे, तो आपका ईमेल आईडी क्या है? उसने कहा मेरे पास कोई ईमेल आईडी नहीं है। तो इंश्योरेंस बहुत शॉक, सरप्राइज हुआ, बोला आपके पास कोई ईमेल आईडी नहीं है? अरे आपके पास ईमेल आईडी होनी चाहिए, अगर आपके पास ईमेल आईडी होता तो आज आपका बिजनेस 10 गुना ज्यादा होता, 15 गुना ज्यादा होता, ये हो सकता था। तो आपके पास ईमेल आईडी नहीं है, आपको पता नहीं कि अगर ईमेल आईडी होता तो क्या हो सकता। तो उसने कहा मुझे पता है, अगर मेरे पास ईमेल आईडी होता तो मैं एक ऑफिस में पियोन हो सकता। सो द मोरल ऑफ द स्टोरी इज दिस, कि चीजें जो भी आपकी लाइफ में होती है, माइट भी आपको उस वक्त लगे कि वो ठीक नहीं है, अच्छी नहीं है, प्रॉब्लम है, लेकिन बी पॉजिटिव, हमेशा जो है उसके साथ आगे बढ़िए। पुराना जो हो गया वो हो गया, यू कैन नॉट चेंज इट, यू कैन नॉट चेंज योर पास्ट, नोबडी कैन चेंज हिज और हर पास्ट, दैट इज इम्पॉसिबल। आपके पास कितने भी पैसे हो, मिलियंस बिलियंस डॉलर्स, यू कैन नॉट चेंज योर पास्ट। सो जो हो गया वो हो चुका है, उसके बाद प्रेजेंट और फ्यूचर को बनाइए, लीव द पास्ट एंड बी ऑलवेज पॉजिटिव। इट डज नॉट मीन कि पढ़ाई छोड़ दो, पढ़ाई करते रहो, जितनी कर सकते हो कर सकते हो। These 3 years of your study will make your 30 years easy in future. Okay. So now we will move on to our numerical part and MCQ. First of all, let's discuss the numerical question. Then we will discuss the test your knowledge. And after that, we will go over an MCQ test. Here is the numerical regarding the calculation of tax liability for assessment year 23-24. Okay, that question Mr. Vishwanatha Reddy asked me day before yesterday, what I was actually forget to solve. Let me take the picture of that question, so I'll tell you in the next session. Okay, Mr. Vishwanatha Reddy. In case of listed security, etc. Yes, okay, everything happened for a good reason. Yes, true. The question now we are going to solve. We have discussed the provision regarding the taxability. Now moving on to our question. Calculate the income tax liability assessment year. Mr. A, age 45, he's a resident. Total income other than long-term capital gain is 2,40,000. So his total income except long-term cap gain is 2,40,000. And because Mr. A is a resident age 45 years, so what is the basic exemption limit applicable on him? 2,50,000. So you can see 250 out of that 250 exemption, 240 has been removed. So we have vested with 10,000 basic exemption limit even now. And long-term cap gain 15,000 from sale of vacant site. So out of this 15,000, the remaining 10,000 basic exemption limit I can also claim. So remaining will be only long-term cap gain 5,000. And what should be the tax rate upon it? 20%. So that is 5,000, 20%, that is 1,000 rupees will be your tax, and you will apply cess upon it, and that will be your taxable income. But because the total income is less than 5 lakh, so we will have rebate up to 12,500. It is long-term capital gain under section 112, not 112A. So rebate is available. So we will deduct the rebate and tax liability will be nil. Now, second example is for non-resident, age 62 years. So if it's a non-resident, okay, so basic exemption can be claimed out of your other income. No rebate will be available. 2,50,000 exemption will be available whether you are a citizen more than 60 years or not more than 60 years. So total income other than long-term cap gain is 280, 250 will be reduced from here. We have having 30,000 rupees remaining, on which 5% tax will be there with no rebate. 10,000 from sale of listed equity share, STD paid on sale and purchase of shares. So you can see now 250 limit has been exhausted. The balance 30,000 is going to be taxable with 5% of rate, that is 1,500. The 10,000 taxable value, listed equity shares, which has been sold from recognized stock exchange, STT has been paid on both sale and purchase of shares. So the capital gain of 10,000 will be exempted as per section 112A, as up to 1 lakh is exempted if any long-term capital gain fall under section 112A. So there is no capital gain taxable over there. Only 2,80,000 was your income, on which tax will be 1,500. There will be no rebate available because he is a non-resident. So 1,500 plus cess, that will be your tax liability. Now see, age 81 year, resident. So that means exemption of 5 lakh will be applicable in this case. 5 lakh exemption is available for this case. 5,90,000 is your income. So 5 lakh has been exempted. Balance 90,000 is going to be taxable at the rate of 20%. 60,000 from sale of agricultural land in rural area. Now the agricultural land in rural area does not form part of capital asset, as we have seen the definition of capital asset. So that is exempted. Only 90,000 is going to be taxable at 20% rate. So that will be 18,000. That is 18,000 is your tax. Rebate cannot be available because your total income already exceeding 5 lakh. So that means no rebate. 18,000 plus cess will be your tax liability. You can see this in the solution, of course. 18,000 and tax. Now last is Mr. D, age 82 year, and he's a non-resident. So exemption is only 2,50,000. So out of 480, 250 will be exempted. Balance is going to be taxable. There will be no rebate available. Balance will be your slab rate tax liability, that is 11,500 and the cess. Clear? So that is my motto, my mantra for all the students. Revise twice. That's my advice to make you wise. Okay. Moving on to our provisions, that is test your knowledge provision. Okay, this I have not uploaded on the portal because that is I have taken from the study material. So you can also find these questions from your study material. There is no uploading of notes regarding this. And this is question number 1. Very, very interesting question. Mr. Mithun purchased 100 equity shares of Messrs. Good Money Company Limited on 1st April 2006 at the rate of 1,000 per share in public issue of the company by paying security transaction tax. So he purchased after paying security transaction tax. Clear? Company allotted bonus share in the ratio of 1:1 on 1st December 2021. He has also received dividend 10 rupees per share on 1st May 2022. He has sold all the shares on 1st October 22. Now you can see that these equity shares were purchased on 1st April 2006. That was 100 equity share at the rate of 1,000. Clear? And bonus share is 1:1 ratio. That is 100 bonus share also we have on 1st December 2021. And these has been sold on, both bonus and normal has been sold on 1st October 22. That means 2006 purchase sold in 2022. So original shares technically long term. Bonus share is allotted on December and sold on October. That means bonus share is short term. Clear? He has sold all the share at 4,000 rupees per share. So he is having 100 long term shares, 100 bonus share short term. Time duration 06-22, and this was 21-20. Long term short term. Sale consideration is 4,000 rupees for per share. That means 4 lakh rupees for this part and 4 lakh rupees for this part. Clear? Brokerage 1% has been paid at the time of transfer. That will be my expense on transfer 4,000 and again 4,000. In both cases, 3,96,000 is my sale consideration. Till now, it's simple, nothing new. Now, security transaction tax has been paid on sale also, that is 0.02%. So, STT has been paid at the time of purchase as well as at the time of sale. So, these long-term shares will fall under section 112A because you have paid STT at the time of purchase and sale both, and we are talking about the equity shares. So, this is called a section 112A. And because these are short-term fulfilling all the conditions, these are in a section 111A. So this is going to be solved as per section 112A provision. This is going to be solved as per section 111A provision. So we can solve it over here like this. Original shares under section 112A provision solution. Bonus shares under section 111A solution, because this is short term and this is long term. The sale consideration 4 lakh. Less expense on transfer was 4,000. 3,96,000. Now we need to find the index cost of acquisition because they fall under section 112A. So no indexation. But for the purpose of cost of acquisition, the special provision will be applicable, which says we need to find the FMV or sale price, whichever is lower. Then this lower need to be compared to the actual purchase price. Whichever is higher will be your cost. So in the example, the FMV has been given 2,000 per share and the selling price is 4,000. So whichever is lower is 2,000. And the purchase price is given 1,000 per share. So whichever is higher is 2,000. So 2 lakh. 2,000 per share is the Cost acquisition for 100 it is 2 lakh. So my capital gain will be 1,96,000. But section 112A say out of the long-term capital gain under section 112A, 1 lakh will be exempted. Only 96,000 will be my long-term capital gain. Clear? Now this 396 is over here and this is short-term. So we cannot find the cost as per the special provision in this case. In this case, we need to find the cost of acquisition as the cost of acquisition chart we have discussed. You might remember goodwill of business, goodwill of profession. Then we were on shares provision, in which ordinary shares and bonus share. The bonus share cost concept was if it is for before 1/4/2001, then the FMV on 1001 1st April 2001 will be your cost, and if it's on or after 1st April 2001, then FMV will be, cost will be nil. So in this case, our cost will be nil. 396 will be our short-term capital gain under section 111A. We also received dividend of 2000. It has been written in question, that is dividend is 2000. And the assessee age is 75 years, who is a resident. Now you can see if it is asked in question that you have to calculate the capital gain, there is one more information in the question. Okay, the information has been. So now we can find the tax calculation because examiner asked to calculate the tax liability. For the tax liability, I have told you, always make these 5 parts. Other, long term 112, short term 111A, long term 112A, and casual. Now I have dividend income. It should be going to be this part. Now we have long term. No. We have short term. Yes. 396. We have long term in this. Yes. We have 96,000. And because the age is 75 years, so the basic exemption limit will be 3 lakh going to be applicable. Out of this, 2,000 has been exempted over here. We have left with 2,98,000, which will be deducted from this part. So my balance over this part will be calculation of tax 98,000 at the rate of 15%, and this is at the rate of 10%. So that will come, total value is 24,300. 4% cess you need to apply, and that will be your answer. So if you are using this diagram for the purpose of tax calculation, let me tell you students, it's really easy for you to find the solution very easily, very conveniently. Solution has been also in the study material, you can find it out. Now question number 2, it says, Arnav convert his plot of land purchased in July 2004 for 80,000 rupees into stock and trade on 31st March 2022. The fair market value as on 31st March 2022 was 3 lakh. The stock in trade was sold for 3,25,000 in the month of January 2023. Find out the taxable value under which head the income is going to be taxable. It's very simple. It's a conversion, section 45(2) case. First of all, PGBP income. Stock and trade sold in 325, the FMV was 3 lakhs. So PGP will be 25,000. For the purpose of capital gain, transfer year will be 31st March 22. So the period of holding is 2004-22 long term. Sale consideration will be 3 lakh. The FMV is a sale consideration in case of conversion cases. And the cost is 80,000. multiplied to transfer year index, which is financial year 21-22, not 22-23. So multiply to 317 and divide by purchase year index 113. Deduct and you will get your answer 75575. It's a very simple question. Okay. Next is question 3. Harshita purchased a land at a cost of 35 lakh in the financial year 45 and held the same as a capital asset till 20th March 22. She started a real estate business. So technically, she converted the asset into the stock in trade again, section 45(2), and converted the said land into stock in trade over business on the said date when the fair market value of the land was 210 lakh. She constructed 15 flat of equal size, quality, and dimension. Out of that land area, she constructed 15 flats. Cost of construction of each flat is 10 lakh. Construction was completed in February 2023. She sold 10 flats at 30 lakh. Out of those 15 flats, she already transferred or sold only 30 lakh. So 10 flats for 30 lakh each in March 2023. The remaining 5 flats were held as stock in trade on so and so. She invested 50 lakh in bonds issued by National Highway Authority of India on 31st March 2023 and another 50 lakh in bonds of Rural Electrification Corporation Limited in April 2023. So you can see section 54 EC also comes into force and it needs 6 months from the date of transfer for investment. So technically she invested 50 lakh in 31st March 2023 and April 23 for the balance. So in that case, only 50 lakh exemption can be claimed, which is within 6 months from the date of transfer. March 23. Okay. Maximum exemption can be claimed up to 50 lakhs. So only 50 lakh exemption can be claimed for NHI, etc. because the time duration was within 6 months for both the asset. Compute the taxable gain in the hands of Mrs. Harshita for the financial year. Clear? So let me help you in solving this question. So this question is very interesting. So the question says in 2000, so question says in 2004-5, she purchased. I always told you for the purpose of capital gain, please decode your question. Find the important values which is required for the solution. So year of purchase was this one. The value of purchase is 35 lakh. This is the first information I find from the question. Then she converted this into stock in trade. And it has been done on 21st March 2022. That is my year of transfer. And the FMV on this date will be my sale consideration. That is 210 lakhs. Clear? Out of this, 15 flats have been constructed, in which cost of construction 10 lakh has been included for each flat. And out of these, in February 2023, 10 flats sold at the rate 30 lakh each. Now, because it's a conversion case, so we need to calculate the capital gain assessment year 23-24 and PGBP income also. So first PGBP income, 10 flats have been sold for 30 lakh each. That means my sale is 300. Less cost is which has been FMV at the time of transfer, conversion, that is technically taken as the purchase price. So the FMV is equal to purchase price, that is 210 lakh. And even after purchase, 10 lakh construction cost has been incurred. So 10 lakh each, and because we just sold 10 flats, so we will take the 10 flats construction cost over here. So technically 210 was the cost for 15 flats. So we will take only 14 flat value, that will come 450. So purchase price will find out like this. So my gain will be 60 lakh. Because we just transferred 10 flats and this 210 lakh is the value for whole property, out of which she constructed 15 flats. So the 10 flats value will be 140 lakh. So the PGBP income will be 60 lakh in this question. Now moving on to calculate the capital gain provision. The capital gain chargeability in assessment year 23-24 will be as follows. The asset will be long term, of course. The transfer period of holding will be from 4-5 till 2022. So the long term capital asset provision will be applicable. The sale consideration for only 10 flats we will take. Only for 10 flats. That is 140. This is 140. That is the sale consideration less. Now you will take the cost. 35 lakh was the cost for 15 flat. So for 10 flat, it will come 23.33 lakh. For which transfer year index, which is 317, that is the year of conversion, and purchase year index, which is 113. So the value will be 65.46 index cost of acquisition. And now my long-term capital gain will be 74.54. In 54 EC, we can take the maximum exemption of 50 lakh rupees. So remaining 24.54 will be my long-term capital gain. I hope it's clear. Moving on to our next question. Here is a solution. You can read the solution. You can read the notes also. Now, question number 4. Mr. A is an individual carrying on business. His stock and machinery were damaged and destroyed in a fire accident. Destruction of asset. Okay. The value of stock lost, that is damaged completely, is 6,50,000. Certain portion of the machinery could be salvaged. The opening balance of the block as on 1st April 2022, that is WDV, after deducting the depreciation, is 10,80,000. During the process of safeguarding machinery and in the firefighting operation, Mr. A lost his gold chain and a diamond ring, which he had purchased in April 2005 for 1,20,000. The market value of these two items as on the date of fire accident was 180. And we received from the insurance company towards loss of stock 4,80,000, towards damage of machinery 6 lakh, towards gold chain and diamond ring 1,80,000. You need to tell the treatment of the above things which have been received by from the insurance company. So first of all, we are talking about the stock provision. So stock is a business part and its treatment is going to be under the head PGBP. So the loss on due to the fire in the business is 6,50,000. That should be shown as loss on fire. Loss by fire, that is 6,50,000 will be as a part of debit side of PGBP, and whatever recovery, that is going to be my credit side. Any receipt, directly, indirectly, for the purpose of business is going to be my income. So that compensation receipt will be my income. That is technically the part of my credit side, and the loss I bear regarding the stock, that can be claimed as a deduction or as a loss as an expenses in PGBP side. So that loss can be claimed as a reduction, and the receipt of that income will be treated as your receipt under the business head. And that is 4,80,000 rupees. A simple treatment. Next is damage of machinery. So in the case of damage of machinery, first of all, under PGBP head, we need to see the depreciation concept. And the concept says the opening WDV is 10,80,000. And the money received for the whole block of asset, the whole block of asset has been totally damaged. The money received for this is 6 lakh rupees. That means we have a value of 4,80,000. And technically, it is not clear in the question that the complete asset has been gone. The whole block of asset has been deemed to exist or ceased to exist or not. So we are assuming that block of asset has been ceased to exist. We are assuming block of asset does not exist. That means no machine in this block. So now we have value for the purpose of depreciation, but no asset, because we are assuming whole block of asset has been destroyed. So we cannot claim depreciation. Depreciation cannot be claimed because depreciation can be claimed only when there is value and asset both exist. So now we will find the capital gain in this case. For the purpose of capital gain, it will be a short-term capital gain or loss. I will take the sale consideration. This is 6 lakh rupees we have received. The opening WDV will be kind of a cost of acquisition, or including everything is 10,80,000. So we have a short-term capital loss of 4,80,000 in this case. Why capital gain? Because we cannot claim the depreciation. I have told you earlier also when we discussed the section 50, that is capital gain in case of depreciable asset. If the depreciation can be claimed, there cannot be any calculation under capital gain chapter in respect of that asset. So because we cannot claim the depreciation in this case, only in that case you should calculate the capital gain concept. If suppose in this question, asset is also in the block, then we can claim the depreciation. Then in that situation, we cannot claim this short-term capital loss over here. This is what we have already discussed. Now the last is he received the gold chain. The price of gold chain he received is 1,80,000. What he purchased for 1,20,000. So we can calculate the capital gain with the help of indexation, like this. For the purpose of gold diamond ring, sale consideration will be 1,80,000 less index cost of acquisition, which is 1,20,000. Transfer index will be the year of destruction, that is 331, and 113 is your purchase date. So whatever will come over here, that will be your capital gain or loss, as the case may be. That was question number 4 from Test Your Knowledge. It's been done now. Now we are left with our MCQ test. So I hope you all are ready for your MCQ test. That is your Sach Ka Samna, of course, the moment of truth. So you should have your pen, paper, and calculator with you. Before I started, I'm giving you 1 minute. Let's get ready for your MCQ test. Some questions are very easy, theoretical based, and some is numerical based question. So I believe you are able to solve all of them if you will pay your full attention. And of course, you will apply the provision correctly. Mohammed is asking us stock and trade is transferred to capital asset in 2023. The capital asset is sold 2026. In which year the PGBP income will arise in case? And what will the cost of acquisition where the this provision we have discussed in PGBP also. In the year of transfer, the PGBP income will arise, but the capital gain will arise in the year 2026 when you will transfer the capital asset. So here is question number 1. Exemption under section 54F is available to. Who is the assessee eligible for exemption? Exemption under section 54F is available to either all assessee, individuals only, individual as well as HUF, or all assessee other than a company. Section 54F exemption is available to whom? Correct. The correct answer is C, individual and HUF. They can avail the exemption under section 54F. The exemption under section 54F shall be available to the extent of capital gain invested in the residential house property, or B, or C, or D. Yes, Rajiv Kumar is correct. Bhumika was correct for question number 1. Madhav was wrong in question number 1. Aditi is of course correct in question number 1. Komal, question option A was incorrect. Komal. Dikshata, individual as well as HUF, correct. The correct answer was C in question number 1. Now the question number 2, you need to read it and give me the solution. Give me the answer. Rajiv Kumar is saying B. The correct answer for question number 2 is B. Well done. Now calculate tax on this. You have a question, numerical question, read it carefully and give the answer. Non-resident individual, read it carefully, including long-term cap gain building is rupees 90,000 is rupees 3 lakhs. So the long-term cap gain of 3 lakh is including after 90,000. Sorry, the 3 lakh rupees income is after including the 90,000 rupees long-term cap gain. So the long-term cap gain building is 90,000 and the other income is 2,10,000 because it has been written in the question that 90,000 included in 3 lakh rupees. So read it carefully and then solve it. Question number 3. Anybody? What is the correct answer of question number 3? When we ask the tax on total income, that means tax plus surcharge plus cess. After that, you need to answer the tax on total income. The assessee is a non-resident. Remember, he's a non-resident. Madhav is saying question number 3 answer. No, Madhav, your answer is not correct. Aditi, you did not apply education cess and other cess also. So the correct answer is A. 18,000 will be your tax and 4% cess you need to apply. The correct answer will be 18,720. Okay. Next question. Total income of a resident individual aged 58 years, including long-term cap gain of building rupees 40,000 is 2,60,000. So in 2,60,000, 40,000 is included. So now you need to tell the tax in this case. Yes, question 3 answer was correct, A. So always apply cess and surcharge provision if the question asks total tax or tax on total income. Fast. It's an easy question. Question number 4. You definitely are able to give the answer. Send me the correct answer. Yeah, Madhav saying I forget to add cess. If you will forget to add cess, institute will forget to add the marks. And if they forget to add, not forget actually, they will not give you the marks on that. If it happens, then you have to give your examination again. So please, these are silly mistakes. Don't do this, because due to these mistakes, you might score lower marks, and each marks matter in the C examination. Remember, each single marks also matters. So please, whenever you know the solution, please apply it perfectly. Because you do not know the solution in those questions, if you're not scoring good marks, it's okay. But if you know the provision and if you just forget to implement it, that really hurts. That really hurts to you when you come to that, oh God, I forget to applying just the cess. So that really hurts after the examination result, etc. So question number 4, correct answer is, okay, Komal Prajapati is saying B. Vishwanatha Reddy is saying D. The correct answer is, of course, B. Because you are again not listening carefully. I told you this 40,000 is included in 260. So the other income is 2,20,000. That is exempted. Balance 30,000. Exemption can be transferred to this 240. The remaining is 10,000. Whatever tax will come on 10,000, that will be allowed as a rebate. So there will be rebate and there will be no tax liability. Okay. Next. It's a theoretical question. Long-term capital gain on sale of listed equity shares and units of an equity-oriented fund shall be taxed. Which statement is true? You just need to tell this. The correct answer is, of course, question number 5. It says correct answer is B. Section 112A we are talking about. If certain conditions are satisfied, individual or HUF can claim exemption under section 54 by purchasing or constructing 2 residential houses, provided the amount of capital gain does not exceed. The correct answer is 2 crore. Very simple. That's why I'm telling you the answer. Okay, this is the question. Please solve it carefully. Ram acquired land from Ravan Limited as on 15th December 2008 for rupees 8 lakh, which was sold on 15th May 2022 for rupees 20 lakh and 50,000. Expenses on transfer were 20,000. He invested 30,000 in the bonds of Rural Electrification Corporation Limited on 16th December 2022. Compute the capital gain for assessment year 23-24. So let me tell you, the Rural Electrification Corporation Limited bonds is not going to be exempted, as the difference in the investment is more than 6 months. As transfer was on this date, and the investment after 6 months. So exemption under section 54 EC is not available. If you solve it now, normally the correct answer will be question number 7, A. You will find out question number 7, correct answer should be A. Ram purchased a plot of land in Agra for 15 lakh rupees on 5th July 2004. The land was sold on 5 June 2020 for 70 lakh rupees. It should be 22. Fine. for 70 lakh, compute the capital gain on sale of the house if he invested rupees 25 lakh to purchase new agricultural land in rural area. So this exemption can be claimed, of course, and you will find out the question. The correct answer will be B. Long-term cap gain 106,194. We are short of time, that's why I am telling the answer. Mr. X has sold his land for a consideration of 25 lakh to Mr. Y, has paid stamp duty of 3 lakh, which is 10% of stamp value. That means if the stamp duty is 3 lakh, which is 10% of stamp value, so the stamp value will be 30 lakh rupees. And we have the provision on section 50C, which says that if the stamp value exceeds 10%, 110% of the consideration, then the sale consideration will be the stamp duty value or the value declared by you, whichever is higher. So in this case, the correct answer is B. Mr. Chandan, age 70 years, received 30,000 every month during the financial year 22-23 on reverse mortgage of his property with State Bank of India. The amount of receipt liable to tax in the hands of Mr. Chandan is nil, because reverse mortgage, in case of reverse mortgage, whatever EMI we receive, it is still in the nature of loan, whether you received it lump sum or you receive monthly installment. It is still a liability because you need to pay it later or sooner. So the loan cannot be treated as your income. So the correct answer is B. So in last class, somebody asked me the concept of demerger. So in 2 or 3 minutes, I will explain you the basic concept, the meaning of demerger. And then we will close our class for today, and we will going to see each other on Monday, that is 24th of July, with my last session, that is income from other source. That will be my last class for this. Okay, so what is a demerger? So suppose there is a company which is called ABC Limited, fine, and it has 4 different units. It has 4 different department or unit. One is textile unit. One is pharmaceutical, which is telecommunication, suppose, and one is automobile sector. So company is working in 4 sectors, 4 different units, 4 departments. Textile is earning 100 lakh rupees net profit in previous year, 22-23. Pharma is in a loss of 40 lakh. Telecommunication in a loss of 30 lakh. And automobile in a loss of 50 lakh. So in aggregate, if you see, the company is in a loss of 20 lakh. Different department is incurring different losses and profit. So this is in profit department, all 3 in a loss. So aggregate, if we'll see the company position, it will show that company is in a loss. And if any company is in loss, what will be the impact of this loss? The share price in the market, because company won't be able to pay dividend, etc. And the investor will think that this company is a loss-making company, so the market share price will fall down, generally. If this company wants any loan to improve the performance of other department, if they'll go to a bank for the purpose of loan, they did not avail the loan or not able to get the loan because the bank will see that the company is a loss-making company. If they want to issue fresh share in the market to raise the capital, again, there will be investor must not be very much attracted into this company because again, it's the loss-making company. So due to this loss, whatever the picture will come into the market that it's a loss-making company, so share price will fall down, no loan will be available, no fresh issue will be subscribed in the market, and so on. After some year, it might be due to the loss of these 3 departments, might be textile department also start earning losses. But the reality was not that it's a loss-making company. If you will see from the point of view of financial consultant, a financial advisor, a proper person who wants to know the financial result, then you will not say that it's a loss-making company. We will say that it's a company, one department having a huge profit, But the 3 departments, due to the loss of 3 departments, this profit has been absorbed. And the final result is loss. So if it will continue like this, it might be possible that in the future, the textile department will also incur the loss, or this company will come to a shutdown position. So in these kind of situations, generally some company do what? They separate this division. The companies say, we will separate this division and create a new company, maybe with the name of ABC Textile Limited. So we are going to separate our one division and going to treat it or make it as a new company. That process is called demerger. The company from which this company will emerge, or we can say the old company. The old company is called demerged company. So ABC will be called in this situation demerged company. The new company which will come into the position will be called resulting company. So we will say ABC Limited, ABC Textile Limited will be called resulting company, and this process is called demerger. But this is not this simple. We have to fulfill a lot of compliances of court, etc. But the basic condition to approve it as a demerger is all the asset. It's same like as per the amalgamation condition. All the assets of this division, the division which is going to be converted into a new company, all the asset of this division should be transferred. 100% asset of this division should be transferred to the resulting company. Only textile division. Same, all the liabilities of textile division should be transferred to resulting company. This should be done on book value. This transfer should be on book value. Value cannot be changed. And at least 75% or more shareholder. In account, this condition is 90%, but for the purpose of income tax, it is 75%. More than 75% shareholder of demerged company should be the shareholder in resulting company. So these are basically 3 conditions which should be fulfilled to effect this demerger process. And due to this, the capital gain arising under section 47 on transfer of capital asset from demerged company to resulting company exempted, and share transfer is also exempted, because the intention is not to sell the company. The intention is to create a new company out of a undertaking which is in a old company. So technically control will be with the ABC Limited shareholder, because at least 75% shareholding will be same. So that is the concept of demerger. I hope you will be able to understand it right away now. And moving on to our provision, we have discussed the capital gain topic completely. If there is any query, kindly send me. I can solve those queries next session of income from other source also, which will be going to be held on 24th of July. So please do revise the provision carefully. Do not leave anything. Go for full study. Do not go for selected study. You have to complete each and every provision. And the basic idea, as I always say, is revise twice. That's my advice to make you wise. So have a very good day and keep study. So Manishi, can we finish the lecture?